Good morning and welcome to the week ahead video with me, David Madden. Today's date is Friday the 25th of October 2019 and the time has just gone 11:40 British Summer Time. And looking ahead to next week, which is Monday the 28th of October until Friday the 1st of November. If we're going to take a look at what's going on in the last few sessions, it's very clear that the big issues of Brexit and US-China trade have been very much in play. So the move this week in relation to Brexit has obviously been dragging on. A lot of the gains that were made recently on the hopes that some sort of deal will be approved and get passed are still largely there. We saw during the week how Boris Johnson essentially got approval in principle for the deal that he brokered with the European Union, but things didn't go according to plan for Boris, for Prime Minister Johnson, as MPs then voted down the kind of shortened timeline that Mr. Johnson was looking to actually get all things wrapped up by. So there's still talk of an election. We've heard from the EU this morning they are going to be having a meeting in relation to the granting an extension. It's economically advantageous for both sides to avoid a no-deal Brexit. So it's probably likely that the European Union will grant an extension. Also, in relation to British politics, we heard yesterday that Prime Minister Johnson set out his plans to hold a general election on the 12th of December. Not long after those plans were set out, the leader of the opposition, Mr. Jeremy Corbyn, quickly said he would not support a general election unless Mr. Johnson took the option of no deal off the table. And let's face it, Boris Johnson is highly unlikely to remove the no deal option from the table. So we could be in this kind of Brexit limbo, or as I wrote in my morning note, the UK could be in the departure lounge of the EU for some time. That's been going on, and it's just because of the almost kind of fatigue. We have seen a bit of a weakness in European equity markets today. But keep in mind, we'll be taking a look at some of the big markets. But keep in mind, we know a lot of the gains that have been made in the last 10 days have largely been maintained. Turning our attention to the US-China trade situation. We heard yesterday from China, who said that they're willing to buy $20 billion worth of US agricultural goods in year one, should the US sign up for a partial trade deal, phase one of it. In relation to Mr. Pence, the Vice President of the US, he was speaking about China yesterday, and he said that if China kind of drop their kind of unfair quote unquote unfair treatment of the US in relation to trade, they could then look to begin a new trading relationship. Mr. Pence also kind of called out criticized China's behavior in relation to the handing of Hong Kong. So he was firm enough on China, but at the same time, he also said he doesn't want the US to decouple from China. So as far as Mr. Pence goes, it was one of his more kind of measured updates. But he's taking a firm line, but at the same time, he's showing that he is wanting to progress the relationship. And essentially, while the language is somewhat constructive and conciliatory, I suspect equity markets in the US are going to hang around these levels, and we're probably not going to have any kind of major sharp move to the downside, at least driven by the US-China trade relationship. The earnings story could be something very different. Turning our attention to next week, what to look out for next week in relation to the big issues of next week. The US back end of next week is going to be the non-farm payrolls. The last month's payrolls figures were overall reasonably good, but given that we've seen some kind of weakness in the employment component of some kind of the recent ISM reports, we could see we could see a lower towards 100,000 or maybe even sub 100,000 in terms of the headline figure. Bearing in mind, last month's report showed that on a yearly basis, average earnings in the US cooled from 3.2% to 2.9%, which is still comfortably above inflation. So workers are getting a real increase in wages. But at the same time, it is a bit worrying because when workers earn more, they tend to spend more. Also, in relation to next week, we have third quarter US GDP, and we also have a interest rate decision from the Federal Reserve. So, in relation to the growth figure, that's obviously going to be closely watched, as is the update from the Federal Reserve. in recent weeks, we have heard a lot of kind of moving away from chatter about the possibility of the Fed cutting rates. My view is that unemployment in the US is at a 50-year low. Granted, wages are coming down a bit, but they're still well above inflation. So I think we've had a couple of interest rate cuts in the last number of months. Do we really need a third in fairly quick succession? Looking ahead to next week, also, what do we have to watch out for? We have the manufacturing PMI reports coming off from the final manufacturing reports coming off from a number of countries. This week we saw the flash report from Germany and from France. Neither were particularly impressive. The French one was showing minimal growth. The German one showed a slight improvement from the dreadful figures of the previous month, which were at a 10-year low. So that's going to be very much in focus. Also, it's worth keeping an eye on we got a couple of interest rate, a couple of central bank meetings next week as well. In addition to the Fed, we have the Bank of Japan, or the Bank of Canada. In relation to earnings, we have third quarter figures from HSBC. Keep in mind, this week we've heard only the last week for the likes of Barclays and Royal Bank of Scotland have fairly sizable write-downs and provisions in relation to mis-selling of PPI, so keep an eye out for that in relation to HSBC. Also, HSBC drive a lot of their funds from the Far East, so the situation in Hong Kong or the general economic cooling of mainland China could impact their business. BP have third quarter numbers out. That's obviously going to be in focus given what's been going on in the oil market recently. We have third quarter figures from Lloyd's, as I mentioned. Keep an eye on Lloyd's, as I mentioned, in relation to the mis-selling of PPI. That's likely to come back and hold Lloyd's because they've been the worst culprit for it. And in terms of kind of big US companies to discuss, fourth quarter figures from Apple and third quarter figures from Facebook. What I'll do now is take a quick look at some of the major markets and see how things have performed. I mentioned at the very beginning of this video how we're a bit lower today as far as European equity markets are looking at, but by and large the gains we've racked up most of for the last week or so have largely been maintained. So if we take a look at the price action on the FTSE 100 here, we've been pushing higher since the beginning of the month. We're back above the 200 moving average, this red line here, which comes into play at 72.73. We're back above that. We're not too far away from this yellow line here. The 100 moving average, in fact, is acting kind of as resistance at the moment, and that comes into play in around 73.35. And if you do have a break above that, it could take us back up toward this zone here in a 7,440 or perhaps up to 7,470. So that zone of up around kind of 74.40, 74.70 could be the next area of resistance to keep an eye out for. If on the other hand the market does manage to turn over on itself, support could be found from this blue line here, the 50 moving average at 72.35. Notice how it nicely acted as resistance on a few occasions not too long ago, so it could be, and if a metric has been important in the past, it makes it more likely it will be so in the future, although there are no guarantees. But even still, a bit below it could find some support from the kind of 72 zone, 7,200 zone down around here. I'll take a look at what's going on in the DAX, and the DAX is in better shape than its British counterpart. So as only yesterday, we had a level on the DAX last seen in June last year. So really give an indication of how bullish things are going in the DAX. But so the trend, the wider trend has been very much to the upside. Currently trading in around 12,000, 1,150. If we drive on higher from here, we could be looking at targeting the big psychological number of 13,000. And if we go beyond that, somewhere in around again at 13,200 could then be targeted. But whatever is ever so slightly concerning is that, well, first of all, the rate at which the market rose between early October and now is fairly steep. So maybe we could see a bit of a slowdown in the rate at which it's increasing. Not to say that a massive turnaround, but we could see a bit of a slowdown in the kind of upward trajectory. But what is slightly concerning is that, well, first of all, the long wick on this candle here denotes a small bit of indecision. You wouldn't really be looking to base your trading idea solely on that. But if you take a look at the MACD indicator, the MACD histogram down here, we can see that it's been actually cooling off and tapering off ever so slightly, all the while the market itself is pushing higher. And when you have that kind of divergence between the two, where the actual market's pushing higher, but yet it's pushing higher on a smaller increases. We're seeing a slight decline in the positive momentum. It could be a sign that the buyers who are still in control could be running out a bit of steam, and we could see a bit of a pullback. So we might look to kind of head back down towards this zone down around here, 12,660 or 12,600. We saw some consolidation in those areas before, so we could see them again in the near term. Take a look now at what's going on over on the S&P 500, the big US market. US markets are in very good shape in comparison to the European equivalents. Take a look here from August onwards. You've seen a lovely series of the lows have all been higher, so a lovely series of higher lows. You know, we're expecting the S&P 500 to open north of 3,000. You know, volatility has been low, but we're still very much in the upward trend. If we do press on higher from here, we could be looking at try getting the recent highs in September of 2022. If we go beyond that, the all-time highs of say in around 3,000, we can say 28 could be on the horizon. But similar though to the what we saw in the DAX, the markets are pushing higher, but we're seeing a cooling off in positive momentum. So it could be a bit of a sign that we might be due for a bit of a pullback. And that should that be the case, it could be looking heading back down towards this zone down around here, 2,970, or perhaps this blue line here, the 50-day moving average, which acted nicely as support and resistance not too long ago, and that comes into play. And that price comes into play in 2,957. And lastly, we'll talk about the British pound. We'll have a look at the pound versus the US dollar. So obviously all this talk of either between Boris Johnson getting a deal as tighter of an extension, you saw a major move to the upside recently in the British pound. Sterling against the US dollar hit a level, I believe it's a 5-month high, a level last seen in May. So things are looking really bullish, above the 200-day moving average. But it's a bit concerning that the market has actually moved up at this rate. We could see a bit of a pullback. The market seems to be turning, couldn't really get a decent move. Apologies. Couldn't get really a decent move north of the 1.30 zone. So we are seeing a bit of move to the downside. Positive momentum is in decline. We could see the market drift back towards this red line here, the 200-day moving average, in at 1.2715, or even now towards the kind of 126 zone. But the kind of wider theme is still very much in play, and a solid break, a decent break north of 1.30 could take us up towards the April highs of 1.3178. Well, thank you for listening, and please tune in next week. Thank you very much. I've been Dave Madden.